The bull market is officially back, but it's a trap. And in the second half of this video, I'm going to be sharing with you an incredible opportunity from today's sponsor, Alaska Energy Metals, so make sure you stick around for that. When taking a look at the stock market, when something drops more than 20%, like the stock market did from top to bottom throughout 2022, dropping 27%, that officially counts as a bear market. And it's officially a bull market again once the stock market rises 20% from the bottom. And as of now, we are about 26% up. A change of 10% up or down is considered a correction. So if you go up 10%, that's a bear market correction because overall you're going down, but you had a slight little bump up, and then the expectation is you continue down. Since we are now up more than 20% from the bottom, the bull market is officially back. But this is not your average bull market, and this does have all the signs of a major trap, so don't get sucked in here. First of all, take a look at the relative strength index, which is currently sitting above 70. The last time it got this high was in August of 2022. As it's a sign of the market being overbought, this was yet another bull trap and the market collapsed from there. And of course, the last time before that the relative strength index got above 70 was in November of 2021. Shortly before the very end of that bull market and before the beginning of the bear market. Now, it's not foolproof, as in April of 2021, the RSI was showing that the S&P 500 was overbought, and obviously we continued to have a major bull run from there. But more often than not, the relative strength index RSI does give a good indication of whether something is overbought or oversold. And right now we are definitely in overbought territory. The second cause for concern is how low the VIX is right now. The way the VIX, the volatility index, is calculated is they look at the money options on the S&P 500. When you take a look at the money options and you look at how much they cost, that gives you an accurate indication of how much the market anticipates the S&P 500 may move up or down. When options are very expensive, that means the market's pricing in a lot of potential movement. Therefore, volatility is really high. When options are very cheap, the market is not expecting a lot of movement. Therefore, volatility is expected to be low. This can be looked at as a contrarian indicator, because typically when volatility reaches very low levels, it's only a matter of time before it spikes again. And we can see that we have to go back quite a bit of time before we see the volatility index as low as it is right now. In fact, we have to go all the way back before the market started to collapse in 2020. So not only is the market looking extremely overbought at the moment, it's also showing signs of extreme complacency. One recent sentiment survey showed bullishness in the market absolutely skyrocketing recently, with massive bullish sentiment coming out of nowhere and bearish sentiment dropping off a cliff. On top of that, the fear and greed index is currently showing extreme greed across all measures. The S&P 500 is trending far above its 125-day moving average. And the current put to call ratio is also showing extreme greed. Now, any one of these things by themselves is not necessarily a sign to go short the market. But when you get multiple indicators all pointing to the same thing, that people are unrealistically and euphorically jumping into equities, that should at the very least be a cause to pause and maybe take action. Especially considering that most investors that are doing this right now are coming from retail. We know that retail, small money, is typically incorrect about these things. The small investor is a contrarian indicator all by itself. Big money makes a move in the market, and then small investors pile on right at the last moment before everything turns around to go the other way. Now, it is 100% true that you would see many of these indicators happen if there were some strong fundamental reasons to believe, hey, this is a good, strong market, a good, strong economy, that things should be improving from here. You would likely see things start looking overbought. You would see volatility start to drop, a lot of these indicators would start to come into play. But that's the big problem here. All of these bullish moves are happening and these indicators flashing warning signs when there really is no fundamental reason for the stock market to be going up like it is. In fact, in just 12 trading sessions, the stock market is up over 5%. And the fundamentals just don't support this. When you look at the price to earnings ratios of all the companies that are driving the stock market performance, they are way overvalued. When you look at the breadth in terms of how many companies are going up versus how many companies are going down, you basically have all this positive performance coming from only 5 companies in the S&P 500, meaning that the economy is not doing well. And on top of that we probably will still be getting more rate hikes this year. The FOMC recently met and said, yes, we are skipping this rate hike, but we'll probably continue to do more rate hikes. Just like we started off with 75 basis points at a time, then we moved down to 50 basis points at every meeting, then we moved down to 25 basis points at every meeting. Now we're just doing 25 basis points, maybe every other meeting. So we still probably have more rate hikes coming this year. And that's coming on the backs of extremely high interest rates already. Interest rates on the United States 10-year Treasury have not been this high since 2010. Now you might be thinking, well, that's fine then. If we've experienced interest rates this high before, like in 2010, then we can get through it now. But the problem is there's a lot more debt today than there used to be. So raising interest rates on a much bigger debt pile has massive implications for the health of the economic system. And so we have a massive crowding out effect right now where money is leaving private investing and just getting loaned to the United States government, which is considered less risky or risk-free in some cases. And they're doing that because you get a higher return than you can get from something that has risk of failure, like in private markets. This drives down economic activity. We're already seeing signs of major retailers preparing for a slow economy 6 months ahead of a holiday season. And it's not just short term here. We see major signs that stocks are going to underperform compared to things like commodities. For instance, when you take a look at how the United States stock market has performed versus the Brazilian stock market, it looks like the relative performance of Brazil is about to take off. This is important because they are a heavily commodity-driven economy, and the valuations of equities versus commodities tends to be cyclical. It reaches lows and it reaches spikes and flip-flops between the two. And recently, commodity prices reached a 50-year low relative to overall equity markets. This implies the beginning of a commodity super cycle that there have been some very smart people talking about for a couple of years now. But these are not short-term moves. These are long, years, decades-long moves. And this is where today's sponsor, Alaska Energy Metals Corp, comes in. Because the world is recognizing that we are about to embark on a very long period of time where real raw materials are far more valuable than they have been in a long time. And so nations are locking down access. They are reorganizing their alliances as we see deglobalization start and a multipolar world begin. Obviously, one of the first and biggest major events leading to this deglobalization was Russia stopping selling energy to Europe. But recently, Chile announced plans to nationalize its lithium industry. Saudi Arabia, who was once 100% allied with only the United States, recently stated we live in a multipolar world order and that the relationship with the US or with China are not mutually exclusive. France has been in talks with China to join BRICS. In short, the resource commodity wars are on. This is why it's so important for nations right now to locate resources within their own jurisdictions that they control. And that's exactly what Alaska Energy Metals is bringing to the table here. Their Nikolai project is in the heart of one of the best jurisdictions on Earth, Alaska. It's a development-friendly area, access to roads, access to energy, and no risk of loss to a foreign government. So what exactly is the opportunity here with Alaska Energy Metals? Well, back in the 90s, the current president of Alaska Energy Metals, Gregory Beischer, worked at the largest nickel company in the world called International Nickel. This company was then been bought by a large $100 billion company called Vale. And you have to realize that this was the 90s. Nickel just wasn't that valuable back then. We didn't have all the lithium ion batteries that we have today. And by the way, nickel is more of a necessary metal than even lithium in lithium ion batteries. There's more nickel in them than lithium. And on top of that, today it is harder to find nickel deposits than it is to find lithium deposits. But they didn't know anything about that back in the 90s. So Vale basically did nothing with this property, despite the fact that it had over $30 million poured into it over the course of the different companies that owned it to do the drilling and to find and prove the high-grade nickel deposits. So Vale did nothing with the property and it went back to public domain. Now the CEO of Alaska Energy Metals, Gregory, he was working for the company at the time when they made that discovery. And so he knew the nickel that was present at the property. And so he waited 30 years and watched this property, and when it finally came back into public domain, it was available for staking. Now, staking is an extremely inexpensive way to get legal claim to a property. And so he was able to go out, from Alaska Energy Company, and stake this property for only $400,000. A property that had $35 million poured into it to drill and develop, he was able to get claim to it for $400,000. This is like going out on a project in the 90s to build like a giant mega mansion. You spend $30 million developing this massive property, and then you just walk away from it, don't do anything with it, let it go, goes to foreclosure, and then being able to somebody else picks up the property for $400,000. Now, this company has an extremely small market cap. Seriously, like mega micro cap. This company right now is only valued at around $6 million US. They have $1.5 million in cash, and so the property is being valued in the entire company even less than that. But there are very similar properties nearby owned by companies that are worth $100 or $200 million. And so when they start this drilling, if they can show similar results, there is massive upside here. This is definitely not a no risk play. For anybody considering investing in this company, you need to do proper risk management like stop loss orders and slowly moving into a position. Stocks like this that are very low market cap stocks can move extremely quickly and with a lot of volatility from what many would consider to be regular sized orders. So building positions in low volume, low market cap companies should be done very carefully, very slowly, and with proper risk management. But Alaska Energy right now has about $1.5 million in cash, which is plenty to do the drilling that they need to do. The market is currently valuing this company at far less than even the amount of money that was spent over the years to show and prove the nickel that it has. So as they start additional drilling and prove these high-grade deposits, there is the chance for significant upside. And as the demand for nickel increases, as it has been for years now, and as deglobalization around the world accelerates and allegiances with former partners go away, access to resources located in your own jurisdiction are going to become even more important. As always, do your own research, and this is not a trade recommendation or investment advice. Thank you so much for watching. Have a great day.